Welcome back to The Explainer. Today, we are absolutely zeroing in on a specific area of the Cambridge AS and A-level accounting syllabus that honestly consistently acts as a massive roadblock for so many candidates. We're talking about adjustments to draft financial statements, specifically focusing on irrecoverable debts. We're going to treat this like a strategic masterclass. By diving deep into the actual examiner reports together, we're going to uncover the exact cognitive strategies you need to deploy to secure those top-tier marks.
Okay, let's dive straight into this. A senior Cambridge examiner literally noted that students constantly hemorrhage easy marks on irrecoverable debts. Now, you might be wondering, why does that happen? Well, it's because while it's pretty easy to just memorize double-entry bookkeeping rules, right? The real challenge, the place where the marks are won or lost, is applying those concepts to the completely unfamiliar context that the exam throws at you. So, in this session, we are going to break down the exact analytical depth and the structured reasoning that you need to elevate a basic, descriptive answer into a high-scoring, evaluative one, all based on what the examiners are actually telling us.
Here is our roadmap for today's masterclass. First, the examiner's lens. Second, core accounting principles. Third, the technical methodology. Fourth, avoiding examiner traps. And finally, number 5, final exam strategy.
Let's start with Section 1, the examiner's lens.
If we truly want to unlock those top marking bands, we have to start looking at our answers exactly how the principal examiners do. And that brings us to a massive, glaring examiner alert. The reports consistently reveal that candidates kind of jumble up key terminology. Listen, an irrecoverable debt isn't just loosely defined as money a business probably won't get. No, it is a very specific debt identified as definitely uncollectible. And because of that, it must be written off to the income statement as an expense, which directly reduces the trade receivables balance. The examiners explicitly state that we absolutely must define these terms before using them in extended high-tariff responses. By establishing this crystal-clear definition right out of the gate, you immediately signal to the examiner that your theoretical architecture is rock solid.
Moving right along to Section 2, core accounting principles. In the rigorous Cambridge syllabus, having just a superficial surface-level knowledge, it just isn't going to cut it. You literally have to demonstrate your competence across 3 totally distinct cognitive domains. We're talking about knowledge and understanding, analysis, and evaluation. Let's break that down for irrecoverable debts. Knowledge is simply knowing the double entry. Analysis, on the other hand, is calculating the actual impact of writing off that debt on the final draft financial statements. You know, asking yourself, how does this alter gross profit? What about profit for the year or net assets? And then we get to the highest level, evaluation. This requires us to assess the wider implications. For example, what's the effectiveness of a company's credit control policies that allowed this irrecoverable debt to happen in the very first place?
To truly hit the academic benchmarks for Cambridge 9706, your approach must prioritize intense analytical depth and logical, structured reasoning. But here is what's truly fascinating when you read through the principal examiner reports. The candidates who connect irrecoverable debts to other areas of the syllabus achieve significantly higher marks. It's like a giant puzzle. For instance, if you write off a large debt, how exactly does that affect the business's liquidity ratios? Or how does this whole scenario relate back to the core prudence concept? Integrating these cross-topic connections proves to the examiner that you understand the entire financial ecosystem of the business, not just one isolated textbook topic.
All right, let's get into Section 3, the technical methodology. When it comes to actually executing your answer, examiners award marks heavily for the procedural process itself. That is exactly why a method mark strategy is so crucial. Now, what's really interesting about this is the mandatory step-by-step sequence it requires. Think of it as a checklist. Step 1, identify the key elements from the provided text, like picking out the specific debtor and the exact amount to be written off. Step 2, apply the relevant principles, such as matching and prudence. Step 3, execute your analysis, and please make sure your working is crystal clear. Step 4, verify those results. And finally, Step 5, present it all in the appropriate format. You have to ensure it's correctly placed in the income statement as an expense and then accurately deducted in the statement of financial position. Sticking to this rigid sequence literally builds a safety net of marks for you.
If you want to master those complex, high-tariff questions, we have to fundamentally understand the difference between a basic descriptive approach and a high-level evaluative approach. A descriptive approach just gives you superficial breadth. It's like saying, hey, the business wrote off a $500 debt, which is bad for profits. Okay, true, but basic. An evaluative approach, however, goes so much further. It identifies limitations, hidden assumptions, and alternative interpretations. An evaluative response might sound more like,
Writing off the $500 irrecoverable debt strictly adheres to the prudence concept. However, if this happens to be a recurring issue, it highlights a critical limitation in their current credit control procedures, suggesting an urgent need to evaluate stricter credit limits. Do you see the difference? That depth of evaluation is exactly what unlocks the top-tier marking bands. And this brilliantly illustrates what happens when you're asked to evaluate alternatives, like, say, comparing two totally different policies for managing receivables. It is absolutely not enough to just list out the facts. We need to actively identify both similarities and differences, and we do this using comparative connectives, words like whereas or conversely. And remember, every single claim you make must be heavily supported with actual evidence extracted straight from the scenario. Crucially, at the end, you must draw firm conclusions on their relative importance. Doing this proves true, undeniable mastery of the content to the examiner.
This brings us to a really important part. Section 4. Avoiding examiner traps.
According to the principal examiner reports, there are exactly 3 primary recurring mistakes. 3 massive traps that cost candidates easy marks year after year when dealing with adjustments to financial statements. The examiners deliberately lay these out in complex scenarios, so let's break them down right now so you don't fall for them.
So the crucial point here is how we strategically correct these traps. Trap number 1 is giving vague answers, basically just making generic, sweeping statements about bad debts. The strategic correction: you must provide specific, hard details pulled directly from the data provided in the prompt. Trap number 2 is ignoring format and presentation conventions. The correction here is simple but essential. Always use proper headings, correct terminology, and clear annotations. Whatever you do, avoid just listing floating numbers with no labels. And trap number 3, this is a big one: answers lacking the given context. Instead of just regurgitating memorized textbook answers, your response has to be tailor-made for the unfamiliar context. If the exam scenario is about a specific manufacturing client going bankrupt, your answer must directly address that specific manufacturing client.
To guarantee that we never ever fall into these traps during the heat of an exam, there's a really helpful cognitive memory hack you can use. Just remember the acronym VFC, Vague, Format, Context. Whenever you finish drafting a response about an irrecoverable debt adjustment, pause and do a lightning-fast mental scan. Ask yourself, is my answer too vague? Is my format perfectly structured? And finally, has this been tied directly to the specific context of the question? Clearing that VFC checklist is a direct, reliable path to securing those maximum marks.
Let's bring it all home. Section 5, Final Exam Strategy.
Let's synthesize everything we've just uncovered into 3 core actionable pillars. 1. Always define key terms, like irrecoverable debts, before you start applying them in your extended evaluations. It instantly establishes your theoretical baseline. 2. Apply the strict method mark strategy sequence we talked about. Make your working explicitly clear, step by step, so those process marks can be awarded even if your final calculation slips up. And 3. Connect those core concepts to unfamiliar contexts and prioritize evaluative depth over descriptive breadth. True success in these exams relies heavily on structural precision and highly professional presentation. So the next time you sit down to review a draft financial statement, I want you to ask yourself, are you merely describing the numbers on the page, or are you truly evaluating the underlying financial reality that they represent? Mastering that difference doesn't just secure you the top exam marks, it is quite literally the foundation of true financial literacy. Thanks so much for joining this explainer, and I'll catch you in the next one.